Hello everyone, my name is Sriram Iyer. I'm an analyst at the commodity research desk at Reliance Securities. Welcome everyone to this week's Bullion weekly podcast. So both gold and silver prices fell this week. Initially prices did show some strength on renewed bets that the US Federal Reserve may go slow on unwinding its pandemic driven economic support measures and kept the bullion close to its 2.5 month highs. But after the initial uptick, markets gave up all of its gain to settle this week extremely on the weaker side of things and came under pressure as the strength of the US dollar and higher US treasury yields outweighed the boost to bullion from deepening concerns of about the global economic growth. Additionally, we also listened to a couple of speeches from the Federal Reserve members. New York Fed Bank President John Williams this week said that it may be appropriate for the Federal Reserve to start reducing the pace of its asset purchases later this year if the US economy continues to improve. Additionally, a couple of other Fed members also said the similar thing, but also added saying that the US economy is still not there. But overall, we felt that this statement by the members was slightly on the hawkish side of things and weighed on the bullion and in fact weighed on the bullion prices this week. Meanwhile, jobs data was also slightly on the positive side of things. The claims data, which came out this week, dropped by about 35,000 to seasonally adjusted about 310,000 for the week ending September 4th, the lowest since mid-March 2020. So I think positive data also weighed on the sentiments for the bullion. Meanwhile, on the main trigger which came for the markets was from the ECB. The European Central Bank said that it will trim emergency bond purchases over the coming quarter or so, taking a first small step towards the unwinding of the emergency aid that was done by the ECB to support the economy during the pandemic. They added that in the past 2 quarters, the bank has bought about 80 billion euros worth of debt each month, and they might look to trim this going forward. However, they also at the same time they also did not provide any specific numerical guidance for the 3 months ahead. But many people in the market are predicting that prior to the meeting that purchases would fall to between about 60 and 70 billion euros in those months. So I think this is also slightly on the hawkish side of things, even though there was no numerical guidance given. But most of the central banks are thinking of withdrawing the tapering, and with this actually weighed on the sentiments this week. Looking ahead, gold and silver could remain or could continue to extend the losses next week as well amid uncertainty over the US Federal Reserve tapering timeline. We see that the dollar and the bond yields will continue to move higher. But due to the uncertainty around surrounding the Fed's timeline, most of the investors will remain on the sideline, which could weigh on sentiments, or we see that there will be no fresh buying in the markets. The benchmark US Treasury yields rose this week after economic data indicated high inflation, and which could persist for a long time. So even though everyone believes that gold is a hedge for this higher inflation, but higher yields translate into higher opportunity cost for holdings, and which is actually a negative for non-interest bearing bullion. So I think if the bond yields strengthen further next week, we see another correction for gold and silver markets next week as well. On the economic calendar front, we have the CPI data next week along with the retail sales data from the US, and both of these will move the markets next week. So technically, we feel spot gold on the international side has given a correction below the 1800 mark, and another trade below this 1800 mark next week start below this level could indicate a further bearish momentum in the markets towards 1774, 1775. 1775 will remain the key support for the markets, and a break below 1775 will pull prices towards 1750 levels. On the upside, we feel 1800 will remain the main hurdle for the markets, and if the market is able to get some traction at lower levels or at these levels, we could see the markets move back towards again that 1830 mark in the international side of things. On the domestic side, MCX gold range for the coming week will be from 46,400 on the lower side to 47,750 on the higher side of things. So that's it from our side. Have a nice day and have a nice week ahead. Thank you.